Now let's talk about interest rates and bond prices. First of all, there's two things that cause interest rates to go up. Number one is credit risk, and number two is inflation. We've just discussed the inflationary situation, so let's talk about the credit risk. When you look at Spain, Greece, Italy, and Portugal, these countries had very modest inflation a couple of years ago. It was running around 2.5%, 3%, a little higher in Spain at 4% in Italy, but pretty much like the U.S. And all of a sudden, Spain's bond went from 4.5% to 7% in a matter of weeks, and over a year and a half, it just spiked up. Greece went from 4.5% to 5% to 30%. Italy went from 4% to 7%, and Portugal went from 5% to 20%. What caused this tremendous increase in interest rates if there was no inflation to speak of? The reason was that these countries were so heavily in debt, and the debt was piling up because of the recession, that people started worrying about getting their money back. So credit risk is one thing that will drive up interest rates, and I'm going to give you the guidelines. In Spain, debt to GDP was 90%. In Greece, which is the basket case, it's 170% of GDP. In Italy, it's 127%. And in Portugal, it's 118%. The general thinking among people in the international monetary thinking is that when a nation gets to be about 115 to 120% in debt, that's when people start worrying about getting their money back. We are today at 103%. We are not at the zone that any of these other countries were in. But I want to point out to you that that is a risk when it comes to interest rates. It has nothing to do with inflation. It is because people would be worried about the credibility of the United States government to be able to pay down that debt. I think it would take at least 5 to 7 years, even at the ridiculous rates that we're going now, before we would get into a position where people would start worrying about getting their money back. That is not a very long time, so we need to be thinking about it now, but I'm giving you the gauge. The gauge is that if the debt to GDP starts to go over 110, 115, and into 120% range, then you start have to think about the interest rate risk due to credit risk as opposed to the interest rate risk due to inflation. I don't see those in the immediate forehand, so I do not believe that interest rates are going to go up dramatically, nor do I believe inflation is going to go up dramatically. In the 70s, we had a very low debt to GDP ratio. That's why the Fed was allowed to be able to continue on. Today, there is so much debt in the economy that it will weigh on a nation if the interest rates start to go up.